Hi everyone, my name is Qingyi and I'm from Economics and Management School of Wuhan University. And today I'm going to share my paper. The topic is research on co-movement between China and USA stock market under the impact of COVID-19. And I'm going to divide it into four parts. It's mainly include the introduction, the analysis methods, research results, and the summary parts. I'm going to start with the background of this paper. With the gradual integration of economic activities, the interdependence of global financial markets has been increasing. International financial activities has penetrated and interacted with each other. Regional financial market fluctuations have also spread rapidly, increasing the resonance risk of the market. China and the US trade often affecting the global economy and finance. Researching China and US stock market links can help developing and developed nations connected. In September 2019, COVID-19 ravaged worldwide stock markets. The Shanghai index plummeted 7.72% and the Shenzhen Composite Index 8.45% on February 3rd, 2020. The S&P 500 overall index of the US hit the largest decline since the financial crisis in 2008, triggering two circuit breakers in March 2020. And the purpose of this article is to conduct an empirical research on fluctuation trend of the China and the USA stock markets during the COVID-19 period. The value of the study is that first, the impact of the epidemic on the financial market linkage of developed and developing country can be exploited in the long and short term. Second, if large-scale public health events occur again, studying the transmission process of the impact of the US stock market on China's stock market will provide reliable evidence to formulate and promulgate relevant regulations more reasonably. Third, the study has important implications for strengthening global policy coordination, jointly stepping out of the financial crisis and avoiding systematic financial risks. And this paper is mainly based on two hypotheses. The first one is the economic fundamental hypothesis, which is based on the complete rational hypothesis, which believes that the relationship of asset pricing originates from the fundamental aspects of assets. And the second hypothesis is the market contagion hypothesis, which pays more attention to behavioral characteristics of investors. The decisive reason for the linkage is the unstable investor factors. And the contribution of this paper is mainly about uh, the and the contribution of this paper is listed below. The existing literature has already analyzed the volatility of the financial market in different ways and obtained many useful conclusions. Impact of the COVID-19 epidemic has had a significant impact on the global market, but there is little literature analysis on this. In view of this, this paper will use Gauge model and other methods to study the fluctuation trend of the stock market in China and the United States under the COVID-19 epidemic. And then I'm gonna explain my analysis methods. Uh, in this paper, I listed two hypotheses. After the shock of COVID-19 due to the limitation of global trading, the short-term correlation of China and USA stock market has declined, but the long-term co-movements remain no change since both USA and China governments enacted a series of policies to prevent the epidemic, which restricted the economic intercourses, externally bringing a slump in short-term correlation. As the stock market shows a great similarity with macroeconomic path, there will also be long-term equilibrium in the stock market, bringing the result that the long-term co-movement of two markets would not be affected by COVID-19. And the second hypothesis is that the market contagion was strengthened during COVID-19, bringing a stronger correlation between two stock markets, especially under extreme conditions. Because market participants are not completely rational, under the global impact of the COVID-19 epidemic, it is more likely to have behavioral characteristics such as convergence psychology and herding effect. The sensitivity of the market and the psychological factors of investors will also enhance the linkage of the stock market. Meanwhile, as the COVID-19 has led investors to panic, both negative and positive impacts will be amplified by the market, which will make the stock market extremely impacted. And in this paper, Jonathan test and error correlation model are used to assess the two country stock markets long-term association. Ranger test and DCC gauge model examine mean and volatility spillover effects in short-term relationships. Finally, quantum regression method is used to analyze market linkage under extreme conditions, and all the formulas and equations are listed below. Then I'm gonna introduce my research results. According to the background of COVID-19 public health emergencies, this paper selected two periods data, January 5th, 2015 to August 30th, 2019 as period 1, and September 3rd, 2019 to December 30th, 2022 as period 2. China's stock market was represented by the Shanghai and Shenzhen composite indices. S&P 500 represented US markets. SISMA provided all data. Due to the different stock market holidays in the two countries, there are certain differences in trading days. Before the analysis, the data of the dates of the two markets that do not coincide were deleted, and a total of 1,885 sets of data were obtained. This study divided the rate of return into two components, the close-to-close return and the open-to-close return, using Hammer's decomposition to examine how overseas market movements affect local market opening and closing prices. The calculation formulas are listed below. And the table on the right is the descriptive analysis results. Except for the weak peak characteristics of Shenzhen adult index in the epidemic situation, the six groups of data show obvious right deviation and peak in two stages, with obvious peak and fictile distribution characteristics, which is non-normal distribution. The Shanghai composite index and the Shenzhen composite index had lower standard deviations, volatility, and returns after the epidemic, while the S&P 500 had higher standard deviations, volatility, and yields. And then I did two point integration tests. The ADF unit root test results show that at a significant level of 1%, the three original index series are not stationary, while the first order differences and the opening returns are stationary. The unit's root test suggests that China and the US stock market index series are in long-term equilibrium. And by doing the Johnson test, the close-to-close return is used here for analysis. In the test of the first and second stages, the original hypotheses cannot be rejected, and the three stock indices have time trends. So model 3 and 4 are better than the model 2. Therefore, in the two stages, the S&P 500 index, Shanghai Composite Index, and Shenzhen Composite Index do not co-integrate. And the Chinese and US stock market therefore do not have a long-term equilibrium relationship. And this research tests the short-term price leading relationship between the China and US stock market using Granger causality and the AIC and SC criteria to choose the appropriate lag order. All lag orders from 1 to 5 were examined for Granger causality because lag order considerably affected the analysis, the asynchrony of the practice of the China and the US stock markets was also taken into account, and Granger causality test was carried out based on the open to close return and the close to close return respectively. According to the SC criteria, the lag order 1 was selected as the main result, as shown in table 3. The Granger results of the Chinese stock market's close to close and open to close returns guides the US stock market's return before and during the pandemic. Before the epidemic, the China stock market's close-to-close return was the major cost for the S&P 500's open-to-close return, which had a modest impact on the US stock market's opening price. The China stock market's close-to-close performance affects the S&P 500's open-to-close return after the pandemic. Then, in order to construct the gauge family models, we first test the artifacts on several sets of data. According to the methods of McLeod and Lee, we set the null hypothesis that the sequence is not suitable for the arch model. The test results show that the p-value of the 12 groups of data are all less than 0.05, and there is arch effect. Arch model can be established. The estimated gamma of the two groups of the returns of the indices of China stock market are mostly significant negative, which indicates that there are significant leverage effects and symmetric effects, and both have passed the autocorrelation McLeod and Lee test and the normal JB test of residuals, and the T-Gauge model has a good fitting effect. This research analyzes China-US stock market volatility spillover using the DCC gauge model. Considering the time differences between China and the US and the asynchronous opening and closing times, the conditional variance time varying correlation coefficients of the close-to-close return of SSEC and SCSE and the open-to-close return of S&P 500 are used to investigate the volatility spillover effect of the two stock markets. The conditional variance time varying correlation coefficients of the open-to-close return and the close-to-close return are employed for the volatility spillover effects of the US stock market. The empirical results are shown in Figure 2. In a previous study, it is found that the USA stock market and China stock market have a certain impact. In order to study the differences between the rise and fall of different stocks markets, this paper conducted a quantile regression on the open-to-close return of the SSEC and open-to-close return of the S&P 500 index, which can show the relationship between at different levels. The formulas are listed below, and the Figure 3 shows the values of quantile regression coefficients. The gray shaded area represents the 95% confidence interval. According to the regression results, all regression coefficients are significant and have an overall upward trend. The Shanghai Composite Index is affected by the S&P 500 index and its own return. And the higher the return, the greater the impact. The open-to-close return of the S&P 500 index is in the United States is the same. Higher own return is, greater the impact on the return from the Shanghai Composite Index, but in general, the close-to-close return has a greater impact on the open-to-close return of the index itself than other country stock markets. So in summary, we tested the two hypotheses in the beginning. Hypothesis 1 predicts no long-term commitment between Chinese and American stock markets before and after the COVID-19 pandemic. China and US financial markets had a strong link, which has increased. Despite the current trend of economic globalization, the capital markets of China and the US are still quite different, and the Chinese stock market is not fully representative of Chinese economic development. So hypothesis 1 is invalid. However, the short-term information transmission of the China and USA stock markets still brought linkage to the stock market fluctuations during the COVID-19 epidemic. And for hypothesis 2, during COVID-19, there was an obvious short-term interaction. After the epidemic, it was further strengthened. The impact of the COVID-19 epidemic had a direct impact on Chinese investors, USA investors, and the world investors. The impact of psychological expectations and herding effects further amplified this influence, which was reflected by fluctuation and strengthened the correlation between the China and USA stock markets. Although single US trade is limited after the outbreak of the epidemic, its short-term relevance still exists. So in conclusion, China's financial market information disclosure system, market supervision system, and laws and regulations are not complete. So the financial supervision department should pay attention to the linkage, the characteristics of information transmission to improve the supervision efficiency and reduce systematic risks. International capital market risk communication needs improvement as well. The preceding cultural test indicates a clear two-way cultural relationship between the US's stock market and the China stock market. China's capital market is increasingly linked to the global economy due to the globalization and internationalization. As a result, China should focus on the internal linkage between the domestic and international capital markets and cooperate with prudent supervision to maintain the stability of the capital market. And these are the references in my paper. So that's all. Thanks for your listening.